What if I told you the biggest opportunity and the biggest risk in 2026 doesn't come from one company, one technology, or one market? It comes from a web of forces reshaping business, jobs, money, and your future. The stock market's rally is real, but it's mixed with volatility. Geopolitics is driving commodities. Economic forecasts are showing resilience, but with risk. Sovereign wealth funds are shifting billions. Long-term investors are rotating into industries most people overlook. Today, we're going to unpack these massive trends so you can make smarter decisions in business, investing, and your career. This is 2026 Market Realities, and you'll want to hear every word before the market moves again. Across the United States, stock markets are showing a mixed but resilient pattern. Futures for the Dow Jones, S&P 500, and NASDAQ climbed modestly as major companies reported mixed earnings results, with Tesla's energy division and Meta's strong guidance boosting sentiment, even as Microsoft's margins dipped. These corporate movements show us something key. The market is no longer driven by simple fear or optimism. It now responds to nuanced performance. Strong results in one segment can outweigh weakness in another. While markets weather policy uncertainty and rate decisions, investors are urged to stay cautious, update watch lists, and prepare exit and entry strategies. One of the biggest stories of early 2026 isn't just stock prices, it's major corporate strategy pivots. Tesla announced a dramatic shift away from some EV models, choosing to repurpose its California factories to produce Optimus humanoid robots, part of a multi-billion-dollar pivot toward robotics and autonomous future technologies. This is not small news. When giant corporations redirect capital, in Tesla's case, more than $20 billion toward AI infrastructure and robotics, it changes entire sector expectations. Capital expenditures of this magnitude reshape supply chains, job markets, and investment calls. Meta also promised expansive investments, planning to nearly double its technology budget, while other major tech players diverge in performance and strategic focus. Political and geopolitical events are more than headlines, they are market forces. Oil prices surged almost 5% due to rising geopolitical tensions in the Middle East, pushing major commodities higher like gold, silver, and copper. Safe haven assets rallied as the US dollar weakened, highlighting a classic investor flight into tangible value. This matters for everyday investors because commodity markets feed into industries like manufacturing, energy, transportation, and consumer costs. Higher oil, gold, and metal prices often signal deeper global concerns, not just short-term trading reactions. Wall Street analysts and institutional outlooks signal that 2026 isn't a simple continuation of past trends, but a transition. Over 700 key market forecasts project that government policies, capital spending, and strategic asset allocations will define this year's winners and losers. BlackRock and other major investment houses suggest that, compared to speculation, 2026 favors fundamental investing over gambling, meaning successful investors will need to focus on valuation, income generation, and real economic growth signals. Even with optimism, risks remain. Policy shifts, regulatory changes, and election cycles could create volatility spikes. Markets aren't trending up because of blind faith. They're trending on performance mixed with uncertainty. All this market news isn't just for traders. It's for entrepreneurs, business owners, career builders, and long-term planners. Economic resilience means businesses must rethink capital allocation, workforce strategies, and growth priorities. Corporate investment in infrastructure and innovation influences job creation, demand for talent, and consumer behavior. For example, capital spending in technology still remains strong even as some sectors cool off, which means roles tied to data infrastructure and financial oversight will be crucial. Business owners should consider how resilient sectors like energy, real estate infrastructure, or commercial services can help balance portfolios and career paths. Despite optimism, economists and investors often talk about the so-called "Sell America" trend, a phase where investors reduce exposure to U.S. assets, including equities, bonds, and the dollar itself, in favor of diversification into foreign markets and alternative assets. This trend reemerged in part due to trade policy uncertainty and geopolitical risk. Such shifts highlight a larger truth. Markets react not just to numbers, but to confidence and risk perception. When investors feel uncertain, they rotate capital into safer assets like gold or international fixed income. This doesn't always signal recession, but it reflects caution. However, opportunities exist beyond these risks. With strong corporate earnings and continued demand for innovation, strategic investors can benefit by balancing portfolios across sectors, not just sticking to mega-cap tech or speculative stocks. Real estate, infrastructure, stable financial instruments, and even emerging exchange products like crypto ETFs, which attracted billions in 2025, are becoming serious components of diversified strategies. 2026 is proving to be a year of transition, not just for markets, but for how we think about money, careers, and business strategies. If you found this analysis helpful, practical, or eye-opening, hit like, subscribe, and drop a comment below telling me which trend you think will define 2026: market volatility, geopolitical shifts, or investment diversification. Your insight could spark the next big conversation and maybe help someone make their best financial move yet.